when you're expending huge amounts of energy to heat things or to grind things, it is still driven by human decision making. But improving these processes can, if you extrapolate it to global scale, save immense amounts of energy.
Hardware to Save a Planet explores the technical innovations that are giving us hope in the fight against climate change. Each episode focuses on a specific climate challenge and explores an emerging physical technology solution with the person bringing it into reality. I'm your host, Dylan Garrett. Hardware to Save a Planet is brought to you by Synapse. Make sure to click subscribe so you don't miss any future episodes. Thanks for listening. Hello and welcome to Hardware to Save a Planet. I'm here and I'm going to try to pronounce both of these names correctly. I'm here with Christian Jeddeloh.
Yes.
Christian is from Norrsken VC, and we also have Sophia Escheu.
Perfect.
From Speedinvest. Christian and Sophia were part of a team that collaborated to develop a Climate Hardware Playbook. This was in partnership among their investment firms and a third firm called Planet A. I've read through this, and I think it's an awesome resource for our audience. The goal of the playbook is to guide founders through the process of fundraising for and building a climate hardware business. It's also for investors who want to include climate hardware in their portfolios. It's backed up by a ton of research. They got input from 118 investors and 142 founders. They analyzed data from 3,600 funding announcements going back to 2015. This was done with a European focus, but in my opinion, there's a ton of actionable advice and tools that are relevant regardless of where you're based. One that stood out to me is a techno-economic assessment template that looks really useful. Just as an example, I'll just give kind of like a high-level breakdown of the chapters of the playbook so people kind of understand the scope. So there's 9 chapters. Those are technology and product, team, business model, capital stack, sales and go-to-market, IP and patents, operations, navigating policy, and impact assessment, which is about measuring the positive impact of your business. Christian and Sophia are 2 of the 5 authors, so they're the perfect people to get into the details of this. Thanks for joining.
Thank you for having us.
Likewise. Excited to be here.
Yeah. And so just so everyone knows, where are you dialing in from? Where are you sitting right now in the world? Where are you?
I'm based in Paris.
And I'm based in Stockholm, Sweden.
All right. Well, thank you. I know it's late in your day, so thanks for doing this. What inspired you to make this playbook?
I think there were probably many different reasons why we actually ended up doing this in the end. How it started out is actually that all of us kind of realized that there's mountains of resources out there for software companies focusing on basically different parts of the funding process, different metrics to track, kind of different milestones you need to reach for different funding rounds, etc. Right? But when you look at hardware companies, and specifically, I mean, Christian and me and also the others, we're all very much focused on climate tech and specifically for climate hardware companies. Those software resources just don't hold, right? Like there's so many things about that. Like if we just speak about metrics, like thresholds, the amounts of funding that you need, the things you need to take care of, like just timelines, margins, etc. Everything is kind of different and a lot more complex. So we kind of saw that the resources out there do not really fit. But at the same time, there's a huge lack of resources and just a gap in, let's say, like online blog articles, ebooks, whatever that fits to and kind of like be a guide for those type of, let's say, a bit more complex asset-heavy business models.
Yeah, maybe just one thing to add, I think, is another point where it came from. Even though all of our funds do invest in hardware, we still kind of end up in ICs where the question is, is this good for a seed company? Is this good for a Series A company? So I think part of it also was, to drive internal knowledge and research around, what does the path of a company look like? Now there's more examples. I think until very recently, there also have not been a lot of climate hardware examples in Europe. So sounds weird, but it's a little bit of a new thing. And lots of the vocabulary and the terms are being kind of, defined and and explained right now in the last few years.
Yeah, there's actually a bit of a trend also going on right now, and also other investors working on hardware reports, which is cool, right? Because in the end, you kind of need to create these type of knowledge bases and for the whole ecosystem and work together and align everyone to get everyone on the same page also.
And I guess kind of behind this, there must be a sense that hardware is important. We need to figure this out because it could be easy, and we'll get into some of the challenges about hardware specifically, but I imagine it could be easy to say, look, we'll just focus on software. This hardware thing is so different. It's so hard. But are your groups saying like we actually can't just ignore hardware? It's important for certain reasons.
I think on the one hand, it's very obvious that we can't ignore hardware. Our entire civilization is built on, materials and energy, money, fossil fuels, and so on. So we need to rebuild how we, do things and how we produce things. I think the other thing is that we do think there's a lot of return potential in hardware companies, climate hardware companies specifically. I mean, Tesla is a great example of a phenomenal business that kind of fits the category and has, I think, has done a lot of things which we actually also included in the playbook, how they paved the way towards the company they are today. Just because the last 20 years have been very much the time of software doesn't mean that this will hold into the future. So I think from a fund's perspective also, we think, A, it's incredibly important that we do it, but B, also that there's a lot of potential for returns and a lot of potential to build great businesses.
I said in the intro, this is for both founders and investors. Is there anything else you'd say about who should be using this as a resource when in the life cycle of starting and building a company? What investors it fits best for?
While writing this, we always thought about this having to be useful for the founders. So we like in the beginning, we kind of also discussed this in our group of authors, I would say, and we spoke about who do we want to target, who should this be helpful for, and we very much decided on founders. So, I mean, there's different types of guidelines and reports out there also focusing on climate hardware, all of them kind of summarizing numbers and the whole ecosystem or dynamics in the ecosystem. But we really said we want to dive into like the nitty-gritty things and process steps that founders should think about kind of, because this is where we see the biggest gap in the market right now. Like everyone can kind of analyze data and numbers, but what is really difficult is to kind of summarize and concise basically findings and knowledge that's in the head of individual people, right? That can be founders at different stages in different or building different types of businesses, can be policymakers, can be investors, different type of investor profiles, right? And we really try to speak to all of those and then in the end aggregate all of our findings and really build something that's helpful for founders that kind of can work as like a guideline throughout their whole funding process, especially when I think it's especially helpful probably for founders that are thinking about kind of kicking off their climate hardware journey. If we speak about stage, I would say that's more like pre-seed and seed stage. Probably at Series B stage, you hopefully mastered some of those things and challenges that we're describing already. And I think for investors, it's basically just about kind of smartening yourselves up and kind of understanding a bit more in depth what the complexities are that founders should and actually have to take care of and think about.
And can you say something about where you got your information and what that process looked like?
No, sure. I think all of us kind of, went through all the existing reports out there. And I think the key inputs, though, were the expert interviews. So we spoke to dozens of experts, and that ranged from, tech transfer offices at universities to growth stage investors to early stage investors, startup founders, startup operators, also, kind of industrial companies and their business development departments. So, like big chemical companies and manufacturers and so on. So really trying to speak to a lot of different people. And I think that's what brought us a lot of insights. And then I think on the data analysis piece, as you mentioned in the beginning, it was with the help of Net Zero Insights, who are building a data platform for climate startups specifically. So work together with them for the data set on the funding rounds to drive some insights around, what are typical funding sizes and so on.
So let's talk about some of the things you learned. And you have this great section, which is sort of rolling up the key challenges for climate hardware companies. What stands out to you both from that? What are the key takeaways in terms of challenges for hardware, climate hardware?
I think two things that really stand out and that were also consistently mentioned throughout our surveys and interviews. I think the first thing is this kind of chicken and egg problem when looking for funding, but at the same time, investors looking for some sort of commercial proof and commercial traction, which is very difficult because like at a certain stage of hardware startups, your technology might not be at the point where you can actually sell it to customers, but you need money in order to get it to that point, right? And I think that's something that we consistently see. Probably one learning or two learnings that came out of that. Like for me, also that like first of all, it's incredibly important for founders to really focus on commercial discussions and building up customer relationships at an early point in time already, even if it might be too early to secure long-term multi-year offtake agreements. You can still kind of engage with, maybe even bring them in as an investor, send samples, maybe even, do some pilot projects around that. And at the same time, and that then also like brings me to the second gap, there definitely is a huge financing gap in Europe. And I think that was something that we heard, that this financing gap is a lot larger in Europe. I think we probably also have some numbers on that in the playbook. I don't know them at the top of my head. But especially at that stage where basically it's time to bring that technology innovation out of the lab, maybe like, basically building not a plant at industrial scale, but larger scale that's really relevant in order to oftentimes also basically produce the quantities that customers would want to see. There's a huge financing gap, and there's kind of a lack of investors that fit exactly that risk profile. And that's something that I think founders unfortunately have faced when raising funds for the climate tech company in Europe. Not sure if you have anything to add, Christian.
Yeah, I think one thing that was also very interesting is kind of, I would call it this element of creativity. And I think the main difference here is that for a software company, it's very clear how you go from pre-seed to seed to Series A. You talk to different sets of VCs, they have different return expectations, but kind of everybody speaks the same language. And I think it's very different for climate hardware startups because in the beginning, they might talk to VCs, but they should also talk to grant bodies and, kind of try to get non-dilutive financing. Later on, that they need to convince larger pools of money, such as infrastructure investors or debt providers. And depending on who you talk to, you need to adjust your pitch. And that's where some of the success cases had this element of creativity, whether it be to, have a very, very deep relationship in the beginning with one customers, sometimes through private connections, or in other cases, have an anchor customer. And from a customer's perspective, an offtake with a startup is obviously a risk. And to kind of cover that risk or give something in exchange, they also, in a few cases, allowed the customer to invest in the company so that they also participate on the upside of the company's development. So kind of these, creativity when it comes to getting financing and kind of going out of your way. And I think that very nicely connects to what Sophia said. It's just so important to be very close to the customers. And I think that's very something that, it's breached in software, but I think the same holds in climate hardware. You need to understand who your customers are, what are their pain points. What seems to be a differentiator is to have a champion, some sort of customer that can act as a champion that you can closely develop with and scale from there.
That's something that has stood out to me talking to so many different companies is that it has to be about solving needs for customers at the end of the day. It's that, we talk about saving the planet and removing emissions or whatever it is, but at the end of the day, all of these are businesses that need to solve problems for real people and other businesses. And if you're not doing that, it's pretty hard to build a business around purely climate impact.
Yeah. And that actually also, I think, relates back to another challenge that was very specifically also named by investors in our survey is the lack of commercial talent in the founding team. Because oftentimes, those companies are being founded out of university, right? Basically, maybe one or two scientists, founders who've developed like amazing tech over the last couple of years and then kind of realized that there's also some sort of commercial value in this and then trying to spin this out, but still with a very strong focus on the technology. And sometimes, I guess, Christian, you also know this, but sometimes then we're like, this founder is just too obsessed with their tech and they're kind of like forgetting the customer needs. And this is something that also surprisingly, according to our survey, founders were not that much aware of. And investors were actually missing quite a lot.
One thing that stood out to me in that kind of section of the playbook where you go through the challenges of hardware is just you have this great kind of series of charts, and you walk through comparing hardware startups or hardware companies to software companies, and you talk about the median gross margin, and it's like 10% for hardware, 70% for software. Time to exit, 10 or 11 years for hardware, like 6 for software. Capital efficiency, lower multiples, exits and survival rates. You just go through all, and it's almost like this wall of, I just can imagine as an investor looking at that and thinking like, why would I bother? Like the like software just on all those metrics looks so much more attractive. But it's interesting, Christian, to hear you say earlier, like actually there's, opportunity for big returns here. But I imagine that's kind of a hurdle for a lot of investors getting into this space.
Yeah, I guess if you kind of flip the coin, at least how we look at hardware compared to software internally, is that in exchange for all these risks that you mentioned and kind of the downsides, I guess one thing that clearly stands out about hardware is that there is overall less competition or less, let's say, higher barriers to entry for sure than in new kind of classical software development. And I think then the other part is that the product market fit risk is less pronounced in a lot of cases. If I start building out a software, I have a few customers in the beginning. I don't really know, if there's 100 or 1,000 customers want the product from the start. And I guess in hardware, on the other side, if you manage to hit the cost curve as you imagine, it's kind of almost like a guaranteed offtake or like a guaranteed market interest at least. So I think you could flip the coin, and I think there's a lot of interesting points about hardware to be made.
Yeah, no, you really see so many of those 0 or 1 cases, right? Where you just, for us, we just really like see, we 100% see the market need. And then in the end, it's just about the tech risk. And so often in our team meetings, we're like, hey, if this works, then this is going to be like a massive opportunity. But it has to work first. And then that's the challenge, right? While I think for software companies, we never really had, like, I don't think we ever had like a similar conversation where someone was like, if this works, honestly, like most of the time the trust that the founders can build this is just there. It's more basically about, are our customers going to buy it?
Yeah, I've heard other investors talk about kind of investing there. You can invest when there's a science risk, or you can wait and invest when it's really an engineering and manufacturing risk. And I think a lot of investors wait until it's clear like the science risk has been primarily retired and now it's about productizing this thing.
Yeah, how we kind of summarized it in our playbook is that like for climate hardware companies, there's the science and the tech risk, then there's the market and the commercial risk, and then there's the operations / the scale up risk. And you need to, as a founder, you need to figure out what type of risk profile, like depending on those categories, the investors that you're speaking to have, and then kind of optimize for de-risking as much as possible. And if there's just a certain tech risk that you can't de-risk and you can't optimize for, then you just have to be even stronger on the market and commercial side.
I like flipping the coin. What are the other sort of reasons that or trends right now that are pointing towards this being a good time to be a climate hardware founder?
I think there are many. I don't know. I would be curious to hear Sophia's opinion, but the last 2 industries that I did a due diligence in, it was cement and real estate, both focused on Europe. When you speak to people from the industry and unprompted, you ask what's the most important thing, the 3 most important things happening in the industry right now. Decarbonization is number 1, is number 2 in a lot of these. So I think you have this big shift in Europe. You have, and that's driven, overwhelmingly by regulation, both in terms of the emissions trading scheme, which is effectively like a carbon price for different sectors, but also kind of EU regulation where there are specific targets, for example, in the case of real estate, where you have to bring your building to a certain energy efficiency standard if you want to rent it out to either residential or commercial customers. And so I think awareness is higher than it's ever been, and that is driven by regulation and a kind of also concerns the customer, right? It concerns the corporates who have to do carbon accounting for the first time here in Europe, who have to report on all these different things and also need to show how they're gonna, decrease their carbon footprint and so on. So I think in overall awareness and regulatory pressure, it's higher than it's ever been before in Europe, and that drives a lot of the pressure to act really from the customer side in the end and buy greener products.
And I think next to higher customer or industry involvement and regulation, it's definitely also just the availability of capital. If we look at the numbers, I mean, we can look at the dry powder, but can also just look simply at the numbers of investments flowing into climate hardware. Numbers have probably, I think, risen like 3 to 4x over the last 10 years. I think that's just like the perfect playing ground, right? Like, and even in Europe, and in maybe specifically looking at Germany, there's a new climate tech fund being founded, like GP going out raising their fund probably every few months, and actually even more and more of them focusing on climate tech specifically and climate hardware, deep tech, right? And now there's actually like even like a new generation of funds simply focusing on this funding gap that I described earlier. Basically, when it's time to build your first of a, I mean, I guess you've probably used that term in your podcast before, right?
FOAC.
Plans, and then there's some funds that are specifically only focusing on that. So there's a huge debate around that, and that's only on the private side, and like even on the public side. I mean, I guess access to public funding and grants is still a lot less than in the US, or at least a lot harder, and maybe also like a bit more intransparent. But Germany basically just founded this deep tech climate tech fund, which is a 1 billion fund, only there to fund climate deep tech innovation, which I think is incredible and a huge opportunity for exactly these type of companies that we are talking about.
Yeah, I was actually going to ask about that, because that first of a kind financing challenge is probably the number one thing I hear from companies, or one of the number one challenges I hear about is that sort of gap. And just to illustrate it, the idea is that you've sort of, once you've proven your tech in a lab and you need to scale up to a pilot, some sort of commercial facility, the costs, there's just this massive step change in the cost to do that. But you're at a point where VCs are kind of shying away because you don't have commercial traction yet. Debt financing is hard because, your risk profile is not like a traditional debt financer would accept. Yeah. What were your takeaways regarding that? And you have a whole chapter on sort of the capital stack and how to navigate that we've touched on a bit. But anything else you'd say about how people kind of navigate that challenge?
It's because I wrote that chapter.
Nice.
I think no, I think it's like, first of all, it's very difficult, and I think it's still a challenge that's unsolved. I think we have to be like super super clear on that. This probably also relates back to what we said in the beginning. It's basically about being creative in your investor setup. As we said, there's different type of investors that are fit for different type of risk profiles, and then maybe at the point in time where it's about to finance your folk plan, then you're totally right. Like, this is actually not something that VCs are made to do. I mean, VCs are not there they really like to invest into like scalable technology that can lead to growth and unlock new markets, and not into CapEx investments. But at the same time, infrastructure funds that are made to do this do not really, maybe they have certain revenue thresholds that you need to reach, right? So it's a challenge that you need to meet, but I think you just need to look outside of the, let's say, usual investor setup that other companies might look for. Maybe your peers who are founding in software are basically working with, and look more maybe even like on the corporate side, right? I think that's something that we've also found out in our interviews, is that corporate investments and strategic partnerships with corporates that can actually finance such operations are completely underestimated, and oftentimes not even thought about. Another option would be family offices, for example, that have a completely different, let's say, return expectation also when it comes to that. And I think most important is just that you really, really basically take a step back, think about what you want to achieve, what the milestones are, what you need this funding for, and to then try to de-risk this for investors as much as possible. And one way to de-risk this for VCs, for example, is also just public funding. grant funding. Try to use grant funding as much as possible. And I think for folk, there's actually quite a good article from Climate VC. I mean, it's very much focused on the US and also funding programs from the US that summarize all the different types of funding options that you have in that space. And it really ranges on also your growth ambitions, right? Like if you already have VCs in your cap table that really feel like, who are like fully aware that this is going to be like their next growth case, then they might actually be open to also funding this. But it's not the case. It doesn't fit every type of company and business model that you're focusing on. I think there's different type of also numbers floating around out there. Basically, financing this with like 50% equity, 30% debt, rest maybe grant funding. We've also put kind of like a small chart in our hardware playbook that's kind of summarizing the type of funding only separated between equity, debt, and grant funding out there. But we specifically kept it like very vague, or like on purpose kept it very vague, just because every company is different, and you don't want to go out there with like one specific recommendation that might not work for a certain model.
Yeah, that theme is really standing out to me, that like you can't just everybody can't follow the same exact path. You've got that idea of being creative and how you design your capital stack seems to really be a big takeaway. You also have this chapter on tech and product, and actually a number of places that I think are really relevant for the actual process of engineering and strategizing your hardware development. What are some of the takeaways for you both related to that?
Just quoting the example of Tesla, and I think that it's quite illuminating, because they had a very, very simple 10-year plan, right? Build a Roadster with kind of, using something more off-the-shelf technology, selling it at a high price, use that cash to put it into like a limousine sedan model, which is the Model S, and then use that money to have a mass market vehicle. And I think that is something that we took away also from founders that we spoke to. It's kind of have a clear long-term plan of like how you want to scale, and have clear intermediate steps, but you will always want some flexibility in how you tackle those, depending on, how the company develops, how the market develops, and so on. So I think this chicken and egg problem of, balancing, customers, balancing investors, but also the technology really comes out here. But I think what we've seen really is like this very clear vision, and then, trying to be nimble and trying to stay flexible as you have these intermediate goals. And I think one part of this obviously is the techno-economic analysis. And it's something we, ask for in every climate hardware company. And it's not just, especially in the beginning, it may seem, tedious, or because in the beginning it's a lot of assumptions, right? But I think it's still so important, because as a startup, you have only very limited resources, and you need to know what to focus on. And, if you're selling commodity materials, or if you're, producing product for industry, then the price is a super important component, not the most important component. And so a TEA can almost be like a strategic document where you know where to focus on. If, let's say input A is only 5% of your cost, then, better focus on the part that is 80% or 70% of your cost. So yeah, I think that was a very, very important chapter to write and kind of illuminate more about.
It feels like as an investor, it must be challenging to look at those TEAs that are built on so many assumptions early on. And I just imagine the amount of kind of diligence to get to a place where you feel confident in those assumptions enough to make an investment must be a challenge. Is that a good way to think about it?
I like the optimism in TEAs. I'll be honest. Electricity prices of $20 per megawatt hour by 2030 for like 100% capacity. I mean, you see a lot of optimism. And I would love it if electricity was that cheap. But I think that's another part, given that so much depends on electrification, or a lot of decarbonization depends on electrification. Like this one metric of electricity price is just so important, and it can completely kill a TEA. But yeah, again, like, if you think from founder's perspective, this shows you, okay, if I have an electricity price that is kind of 2 times lower than it is right now, and I'm running at 100% utilization, something needs to give. And again, this really helps you work out your strategy. And, there are other approaches where you kind of go for direct installation of energy, i.e. solar, and kind of, on-site solar and run at a lower utilization and kind of get the cost of electricity down that way. So yeah, again, I think it's a really important part of any hardware company, I think.
It's definitely a challenge for us as investors to kind of evaluate the TEA. I think some funds actually have their own like impact or science teams that do that. And it's important to understand kind of also like get let's say like our own perspective on those unit economics. So it's like the founder's perspective might be that there might be one side, but then maybe there's many other things that we'd like to kind of factor in. So it's important to understand it. But I think actually even more important than that is actually basically just seeing that the founders kind of had a look at it and understood also like the relevance and know like the different variables and parameters in their technology that are going to change the future of this. And that's, I mean, oftentimes like you wouldn't expect this, but oftentimes actually when we ask for a TA, the founders need to build it first. And that's always I wouldn't say like a no-go or like a very bad sign, but it's definitely not the best sign because it tells you that maybe that's something that they haven't thought about before. And oftentimes then they argue that everything is still so hard, so unpredictable and so many like moving parts. But in the end, it's exactly about this, right? Like understanding what are the moving parts and how are they actually like impacting it. And that's why I'm saying like in the end, we all know, and like we invest at Speed Invest, we invest at a pre-seed and seed stage. So really at a point in time where the TEA probably is nothing but false or nothing but a prediction for the future. And we know this. And that's also why we, for example, we do not have like the specific science team or impact team that can actually do that. And oftentimes also do not even do post-term sheet, like technical due diligence on the TEA, because we just know everything is made up in the head of the founders, but it's really just about realizing that they thought about it and see it as an important part of their business.
What about the team building side of it when you're thinking about developing hardware? I mention that because my day job at Synapse, we're kind of engineering consultants. Companies will hire us to be part of their team as they scale up. Did you have any takeaways about how to build a hardware development team through this process?
I think it is probably, when it comes to team composition of hardware companies, this is something that changes very, very dramatically from seed to Series A and to Series B. And I think, so Sophia, you invest a bit earlier than me, but I guess when we invest at seed Series A, we want some balance in the team. So there needs to be obviously the technical side, be it the science or the manufacturing and the scale up. You also need the commercial side, somebody who is doing all the customer interactions and so on. But once you hit Series B, actually, given that you're by Series B, likely you're going to talk to banks, you're going to talk to infrastructure investors, then you also need a CFO. So as the company scales, you have a very, very growing C-level team. And I guess when we spoke to growth investors, they're really looking for kind of, like a top-notch team when they invest at Series B, at Series C, that kind of reflects all the different things that are going on in the business. And, if you look at our hardware playbook, it's, software would maybe cover like 4 of these areas, but now there are all these other areas that you need to be taken care of. And so I think that very nicely shows how much it changes over time. And I guess, Sophia, I don't know, at pre-seed, kind of, then it's, 2-3 people, right?
Yeah, exactly. So I think at pre-seed, we usually look for someone that can cover the commercial side and someone that can cover the technical side. And then also kind of like them understanding that it might be important to think about hiring like a COO who can think about the operational supply chain, feedstock sides at seed or Series A stage.
Yeah, I don't know. Did you look at the questions I had around sort of the like other context and things? Was there anything in there you felt would be good to hit?
I guess we can talk about some of the differences, right, between Europe and US, given that you have so many people listening in the US. And I guess that was also something that was a bit surprising to us. When it comes, obviously there was the US IRA, which I think, obvious to say that this was probably the biggest, or this was the biggest climate financing, climate infrastructure bill ever created. The European Union's counter, or kind of, obviously the European Union wants to stay competitive and wants the best companies to build the infrastructure here and so on. But it's still very much not set in stone. It's not as clear. So the EU Green New Deal is kind of an overarching framework, but then it all depends on the individual member states. And I think that's also one of the things that, is a challenge for especially hardware in Europe, that every country has a different permitting scheme. Every country has different subsidies. You can see that, for example, in Germany, you get huge subsidies for the likes of Northvolt, very not climate hardware per se, but Intel also built a new factory in Eastern Germany and got huge subsidies. So, when you have the gravitas, it's very much possible to get these subsidies. But for startups, it's a lot less transparent. That being said, there is still, there's a lot out there in terms of subsidies and grants that you can access. But I think overall, the beauty of the US IRA, and we hope it survives post-November, is that you have very clear production credits. You have very clear investment tax credits. So it is kind of, very direct and very easy to understand. And I think that's one thing where the European Union, at least in terms of, tax credits, is lacking a little bit behind. But now we've seen, a few times now that overall, when it comes to carbon pricing, I think European Union is ahead of the US. So as far as I know, it's, I think, less than 10% of the emissions in the US that are covered by a trading scheme or emissions trading scheme, which is kind of an indirect price. In Europe, it's over 40 now and kind of increasing. You also have a carbon border adjustment mechanism. So kind of when you import products which have a carbon footprint into the EU, you pay like a tax on it, basically to even out the playing field for European companies who pay this ETS and international companies. And so I think that is, on the other hand, from the regulatory side, where you have more incentive for companies to change. But yeah, I think we again we run into the issue in Europe that it's still quite fragmented overall.
Do you see European-based startups looking to access IRA incentives, but trying to get into the U.S. market and do U.S.-based manufacturing and commercialization to get after those incentives?
Yeah, that was actually a very interesting example that was just, I think, a few weeks or months ago. A company called Again Bio from Denmark, which actually raised a very large round from VC. So it is possible. They raised 40 million from HV Capital and Google Ventures, topped it up with non-dilutive grants. And they are building their first industrial facilities now in the US because they are doing carbon conversion. So they are making use of the CO2, kind of captured CO2 point source tax credit in the US. And overall, and we also speak to our portfolio companies about it, obviously. Where it makes sense, where the incentives in the US are very clear and very tangible, then it makes sense to think about expansion. I think this has probably changed also over the last few years.
And I think it's probably just very general, the availability of capital. Like in the US, there's just a lot more capital available. Like in general, as you probably know, right? Like there's a lot more capital in the whole venture capital sector, but then also very specifically focusing on climate tech and hardware. US investors are just, let's say, like more open towards these type of models, and at the same time also paying better prices. And that's actually something that like we sometimes even like recommend our portfolio companies, or kind of like when speaking to potential investments that are evaluating like the future funding strategy, oftentimes we say basically from Series A onwards, this is going to be this is going to be like a US company, because it's just going to be a lot easier to raise money from US investors compared to Europe, which is probably one of the biggest challenges. And then in the end, also that's not just a hardware problem, right? Like even if you look at like the software companies, maybe they raise the first 2 rounds from European investors, and then they look to US investors because those are the ones that can really like finance these super high growth journeys like after Series B onwards. That's a huge problem, right? Because we don't want all of those companies to basically move to the US or kind of generate returns that are in the end flowing back to the US, and in the end that also comes down to LP money, right? And I think one instrument that's super important here is pension funds. And I actually looked up the number before that. I think there's less than 2% of all pension fund money flowing into venture capital, or like alternative. No, I think venture capital only. Versus in the US, that number is, I think, goes up to 10% per fund, which can have like quite a big impact. No?
I will say I feel like recently it doesn't feel like capital is flowing quite as freely in the US in the climate space as it had been the last several years. Climate Tech VC just put out this report that we're back to sort of 2020 levels of investing climate tech generally. So,
but would you say that's a difference? There's a difference between climate tech and tech software in general, or is it more like the overall industry?
I think the overall industry has contracted.
No.
So it's everywhere, and that's related to interest rates, and there's I think a lot of reasons for it. But overall it has contracted. Although I think the AI sector has been getting a lot of funding. So hopefully that turns back around.
Let's see. I mean, it's still good. I think AI needs funding, especially in Europe.
Yeah.
But maybe AI at the intersection with climate.
So kind of related to another thing, I'm always curious to ask investors, because you have sort of such a broad view, is do you feel like, would you call out any sectors of climate that you feel are particularly underhyped or overhyped?
Contentious one, but I think on the overhyped side, I probably would put green hydrogen and direct air capture. And I think this goes back to electricity prices. And, I think in the next 10 years, the way things are going with all the grid investment we need and the additional energy production infrastructure that we need to build, I think it's very hard to see a world where electricity prices will go down materially. It's a limited amount of renewable energy we have, and kind of we need to ask ourselves the question, where is it best spent? And I think those are some areas that might have a future, but it seems like, in the next 10 years with higher energy prices, it will be very challenging. So I think those are on the overhyped side. I think on the underhyped, maybe it's not as sexy, but it's just the improvement of industrial processes. And, you can think about things like cement and steel, where it is interesting and shocking to see how manual decision-making is still dominant there. Kind of when you're expending huge amounts of energy to heat things or to grind things, it is still driven by, in a lot of cases, human decision-making, and kind of, this is like a very broad field, but improving these processes can, if you extrapolate it to global scale, save immense amounts of energy. And so I think that is something that is not as top of mind, but has a huge impact potential when it comes to CO2.
Interesting. So not sort of fundamentally changing the way we produce cement and steel, like there's people working on that problem as well, but you're talking about just kind of making those processes more efficient by using technology.
Yeah, and I think it's both is needed, right? So I'm not saying that we shouldn't invest in new ways to produce steel, cement, and so on, but I feel it's sometimes underestimated how much potential there is, and not just steel and cement, but like overall industrial processes, just because these are very old industries. And it's not as digitalized as you would think in a lot of cases.
Well, maybe a good place for AI.
Exactly. I didn't want to name the buzzword, but yeah, it's a prime application of machine learning.
Yeah, and fully agree. Also on the overhead side, maybe at like anything around EV infrastructure and like charging infrastructure. But maybe that's just because I focus on pre-seed, and at that stage, I feel like we've seen a lot also, like at least in Europe, right? Like sales are stagnating a bit. But what's underhyped, I think, is anything around climate adaptation. I guess that probably also fits what you just said, Christian, right? But basically kind of trying to make sure that our current systems are resilient. And with that, very specifically, if we look at food and agriculture, I think there's quite a lot we need to do when looking at kind of like the impacts of climate change on our soils, on our weather conditions. Like we currently see a lot of models, and also really like diving into topics around how we can make food and crops or plant seeds and crops more resilient, resistant to pests, resistant to specific like soil conditions. I guess gene engineering is a word here. No, I think there's going to be many more companies actually focusing on that side. Because I mean, I think the climate impact is always judged in that case, because you cannot put like a certain, let's say, number of CO2 savings on those models. So I'd actually be interested in how some climate and impact funds would evaluate the impact, because sometimes they are specifically looking for certain, numbers of CO2 emissions that are being avoided. We see huge potential in that. And also like from the industry, there's quite a lot of R&D also going on in-house on those topics.
Yeah, that's a good point. I have 3 questions that I ask everybody to close us out. How about we just go Christian first and then Sophia on each of these? How optimistic are you about the future of the planet and why?
I'm optimistic because I think that kind of the exponential development of the past when it comes to technology is a huge force. There's never more climate change companies than today, so that makes me very optimistic. At the same time, I think the hardest thing is yet to come, and I think the hard decisions have not been made. We're still at peak emissions, but I think overall I'm optimistic.
Yeah, no, I think totally with you, Christian. I'm also optimistic. Like I would say cautiously optimistic, but I'm optimistic. I mean, we see great advancements in technology. We do see the right kind of policies and agreements, such as like the Paris Agreement, like being put in place and being like enforced on national levels as well. Corporates are setting high goals for sustainability. I think in the end, like now it kind of counts, or what counts is to align all of these different type of initiatives and stakeholders, because in the end it's a huge multi-stakeholder project that we need to manage, and there's not really one responsible person that needs to manage it. So it's very much about kind of like, aligning from within. That's going to be a challenge, but I think we're on the right path.
Who is another person or company doing something to address climate change that's inspiring you?
I got a name portfolio company because she's so amazing. Liz from Material Evolution, Liz Gilligan, super inspiring person, great personality, and just this relentless drive of not waiting, and kind of, straight out of a PhD, founding a company in the cement industry, alternative materials. So as hard as it gets, currently building their first of a kind in the UK, and a great inspiration for sure.
Nice. I'd love to have her on the show.
Same for me. It would be a bad investor if I wouldn't name one of my portfolio founders. I'm calling out David, the founder of Hexa Farms, actually, who I think is like an amazing person to look up to within climate, because he's just so intrinsically motivated to make a change, but at the same time also seeing this like huge, in the end, return potential, and like revenue potential. He's focusing on food and egg adaptation, kind of building software for greenhouses. And why I had to think of him in this context is actually because he actually now decided to, I mean, it was a software company originally, and then he realized that all of the cameras and sensors that they are working with, or third-party sensors they're working with, are just not working it, and need like lots of maintenance, and basically they break down like every couple of weeks at customer side. So he now actually decided to develop cameras themselves, turning this like software company to a hybrid software/hardware company. And I think us as investors for the first time, this is just very recent. Actually, not sure if I should announce this here, but now I did. And we obviously, like us as investors, we were like super cautious about this, kind of telling him that he should think about this twice. What will this mean about for like supply chain, etc., etc. But he just, I think, in that moment didn't care that much about what we think, because he just realized it's right for the business. And like within weeks, they've developed their own hardware or camera that's now apparently already being installed on customer's side, performing a lot better than third-party parts and components, which is cool.
Nice. What advice do you have for someone not working in climate today who wants to do something to help?
Given that everything we consume and touch has a carbon footprint, I think the climate transition will affect every industry. So, kind of reading up, no matter which industry you're in, and trying to think, how is it going to impact my industry? And I think the second thing is that sometimes I do think we need like a better narrative. And I think, there's a lot of doomerism going on, but I think I would flip it around. And, if we manage to do the climate transition, it will be very, very good for our civilization. We'll be a better civilization. And, the sky's the limit, literally, not even. We could be multiplanetary species. Trying to say humanity's potential is endless if we fix this, and trying to, have a positive spin around the climate transition, which a lot of people see as a burden. And I think that we need to have a better narrative as an ecosystem.
Yeah, I think totally agree with you, Christian, as always. But I think probably like what advice would I give someone? I would basically say in the end, like, climate is not climate. And I think there's not like one single way how to kind of actively engage and like help or kind of like support any sort of climate movement. I think in the end, it's basically just about finding an industry that excites you, that you're interested in, try to understand it from A to Z, like understand all the different moving parts that do have an impact in the end on this industry's environmental and carbon impact. And then I think actually you'll naturally find a million ways to make it better. And just try to hop on that opportunity then.
Awesome. Christian and Sophia, thanks a lot for your time. This has been really great. We'll put a link to the playbook so people can find it in the show notes. And I hope it's useful for a bunch of folks out there. Thanks again.
Thanks for having us, Dylan.
Thank you so much, Dylan. It was a lot of fun.
Hardware to Save a Planet is brought to you by Synapse. To find out more about us and how we develop hardware solutions for the world's most ambitious companies, head to synapse.com. And then make sure to search for Hardware to Save a Planet in Apple Podcasts, Spotify, and Google Podcasts, or anywhere you like to listen. Make sure to click subscribe so you don't miss any future episodes. On behalf of the team here at Synapse, thanks for listening.